Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny.
And we did a video on TLT and how utilizing TLT, I believe, can bring back superior returns over the next couple of years. We got a ton of questions. Mainly, we're going to talk about why I don't want to do a leverage ETF, why we're not afraid, me, am not afraid of Bill Ackman short, some other specific strategic things with TLT. So if you guys are interested in this trade, this is super important.
Two Super Guys Trade Stocks.
All right. So real quick, the theory of this trade, which initially Burry was in it shorting. I shorted with him. He got out. But I was like, why did you get out? So I stayed in. We made money. And now I'm trying to write it back up. That's like 8 videos. It's kind of funny.
That's basically the last 2 years in a nutshell.
Yeah. So the theory of this trade, and we posted the question, so hopefully we get to all of them. But bonds and yields have an inverse relationship. We had increased rates substantially to stop rampant inflation due to COVID crisis. Don't overthink this. Jerome Powell, regardless of news outlet articles, has been extremely steady and consistent with his plan. Most likely to have one more rate hike. This is key because over the last year and a half, if you did not read one article on interest rates and you only listened to Jerome Powell's speeches after each time they met, this was not a hard trade. This was incredibly easy. He was not playing shadow games. He was literally being like, yeah, we need a 5.25 rate. We're at 3. So we're going to keep on raising rates, right?
Yep.
But the thing that you don't get is like Wall Street Journal, Financial Times, what have you, they make money on clicks. So every fucking time there's like, this is the last rate. They can't do this again. And then you're like, oh my God, the world's going to collapse. And every single time, Jerome Powell's like, what are we at? 3.5? I said 5.25. Okay, we're going to go. We're going to keep going. Just every single time. It's not a surprise. All right? That's where I think some of the nuance is being lost in this. The third part, as a core PCE comes down, rates will have to decrease, thus increasing TLT. TLT is a 20-year treasury bond, yada, yada. And then 4, the longer the rates are high, the faster the economy erodes and the U.S. government will have to take on more debt, i.e. the more debt the U.S., which the U.S. loves debt, the higher the interest rate they pay, the worse it is for us. For the government, for the American government. Let's go with that.
Yeah.
So here is TLT over a very long period of time. I'm going to move your face. This is back to the financial crisis. Let me see my arrow. There we go. This is a financial crisis, right? And we're all the way back down to around that level, okay? So my argument is, and don't listen to me. I'm not telling you guys what to do. I'm going to tell you what I'm going to do with my $50,000 and why. I will be slowly buying TLT, but we had some questions. This was a very good question. So what's the effect of a stock market crash on TLT? Let's say the stock market drops a decent amount. What happens? So what happens? During periods of economic expansion, bond prices in the stock market have an inverse relationship. Okay, they're competing for capital. After a recession, interest rates are low, inflation is high. They kind of move together, which is what we've been seeing as they've been increasing rates. Okay, there's going to be a lot of factors that Bill Ackman is going to bring up in the next slide. I don't give a shit. Interest rates are the most important thing when determining bond yields. You cannot have interest rates going all the way back down and having the yield not move. It doesn't make any sense. That's not how it works. So anyways, as interest rates rise, stock market usually, clearly not right now. This is an average statement. Stock market falls. Selling the stock market leads to higher bond prices and lower yields as more money moves in the market. Now, interest rates are increasing. The stock market is not having a problem at all. But there can be a lagging effect We've looked at that in other videos. In my opinion, I think the stock market may have a rough couple years ahead of it. No one knows for sure. You want to get this one?
Yeah, so I thought this was an interesting question. They're basically asking about the TLT ETF actually pays a 3.2% dividend yield, and they were asking why do you just buy the bond for 4.3% dividend yield? Dylan is not trying to like yield farm in the traditional way. What he's trying to do is actually capitalize on the change in value of the bonds themselves because the yields are changing. So they're related and inverse, but it's not exactly like six and half a dozen kind of situation. So the whole thought process here is when you look at a bond price and like this kind of relationship here, you're discounting the future value off of the top. That's why the price is like the opposite here. It's like how much would you pay me today for a dollar tomorrow kind of deal. I forget what that's from, but that's actually the nature of the inverse relationship here is that the less I pay you today for that dollar tomorrow, the higher the yield is. All right. So he's more trading on like the collapse in price of the bond than it is truly on like the decrease of the yield, or then in, his hope here is that the value of the bond increases significantly as the yields drop on this opposite side trade that we're, looking at initiating now.
And to be clear, according to Jerome Powell, which a lot of this trade relies on him not lying to us, which he hasn't yet, we probably have one more rate hike. And we could very well chop around for quite a long time, for maybe a year or two. That's very possible. But part of this is doing covered calls and puts around a range that is set after some time, which I have been doing. It's called a wheel strategy. It's working very well. So this is the question. Okay. Now, when I was trying to prepare for this question, do research, Ackman actually just tweeted his entire thesis as to why he's shorting. So this is fantastic. We're just going to read it. But basically, he's shorting 30-year Treasury bills as yields could hit 5.5% soon. The soon part is super important here. Okay? Just to be clear, I have a certain amount allocated for this. I'm at 30% in to what I want to be of my 100% cash. I'm slowly getting in so then I can have money to do covered calls. So that's kind of part of it. I'm expecting TLT to go down further. That's very important. So I'm going to read this real quick. If you don't want to read it, just fast forward. But basically it says, I've been surprised how low the U.S. long-term rates have remained in light of structural changes and are likely to lead to higher levels of long-term inflation, including deglobalization, higher defense costs, energy transition, growing entitlements, yada, yada, yada. As a result, I would be very surprised if we don't find ourselves in a world with persistent 3% inflation. One, if we hit persistent 3% inflation, it's likely that the rates are still lower than they are now. So either way, I still win. So that's fine. It's not 2%. I just wouldn't be as much of a winner. And one thing I don't like about this is there's a lot of predictions here. Like none of these are solid statements. And let's say all of those happen, no matter where you put your money, it's going down. So...
Yeah, that was my general thought reading his entire perspective here, is that he's basically arguing that this isn't a revert to normal situation, that this is the new normal situation. And that say that 3% inflation continues, Jerome Powell would have no reason to decrease rates. He would just maintain rates because they've never achieved his 2% target. That's what he's basically arguing here, is that forever we live in this environment now.
Yeah. And in this strategy, that's okay, because we're doing part of a wheel strategy until they start to pivot. So that doesn't matter. You can still make money doing this. Then from a supply and demand perspective, long-term treasuries, or T, also look overbought. With 32 trillion of debt and large deficits as far as the eye can see, higher refinance rates and increase in supply of T is assured. When you couple new insurance with quantitative tightening, it's hard to imagine how the market absorbs such a large increase in supply without materially higher rates. Once again, the rates can stay high. That's fine. They don't have to go low. I am at no point expecting rates to go down as fast as they came up. I mean, that would be awesome, but I don't think that's going to happen. That would be...
If they go down, they go down fast often because it's in response to like a global crisis or a
Yeah,
recession or some horrible event.
I agree.
So they can move down very quickly if they happen to move down.
I don't think that's going to happen, but with some of the things he said up here, they would probably go down because a lot of those things are bad. So this red box is just him disagreeing with how the government has done things. That's fair. They mess up a lot. Then consider China, other countries' desire to decouple financially from the U.S. That's been happening forever.
Yeah.
YCC ending in Japan, the relative appeal of yen bonds versus tea for the largest foreign owner of tea, and growing concerns about U.S. governance, fiscal responsibility, political divisiveness. That's not going anywhere. And a Fitch downgrade. There's just a lot of if statements.
Yeah.
There's a lot riding on this. So
In other
this is
news,
important.
water is wet.
Yeah. I mean, that's been happening for like 30 years. So I don't, yeah.
Yeah, exactly.
So if long-term inflation is 3% instead of 2% and history holds, then we could see the 30-year T will equal 3% plus a 0.5% plus 2% term premium or 5.5%, and it can happen soon. There are many times in history where the bond market reprices the long end of the curve in a matter of weeks, and this seems like one of those times. I believe his short, which is very valid as of right now. Like I said, I think TLT is going to go down. I think he has a matter of weeks timeline. Like I don't think he's going to be shorting for a couple years. I think he's going to be shorting for less than a year, if I'm reading this correctly. Then he said, that's why we're short in size. There are a few macro investments that still offer reasonably probable asymmetric payoffs. This is one of them. The best hedges are the ones you would invest in anyways. So that's a good statement.
Yeah, but I don't understand. The first part he says there, first as a hedge of the impact of higher long-term treasury rates on stocks. So he's saying first as a hedge, but then he's saying the best hedges are those that you would invest in anyways. What's like that? I guess that part makes sense, but it's just like, wait, is this? Are you thinking of this first as a hedge, or are you thinking of this as a trade you would take and as a hedge? Like that's why it's a little discongruous there. If it makes sense to me.
He states in a matter of weeks up here, so that's his timeline, I would assume. But there's so many if statements. The grass is always greener every year. Every year it's like, hey, this sucks. China's trying to do this. They've been doing that since the 90s. That's not a new thing. Someone had mentioned 20-year and 30-year treasury securities are very different. It's not really true. Here's a 20-year. We're at a 4.41 as of when this was taken today, and then 4.24 for 30. But the graphs look almost the same. So that's kind of a done deal.
Just long-term
Personal PCE, including food, you can see that we're starting to level off. So we're most likely, if I was Jerome Powell, which I'm not, and am not in any way should be saying this, I'm not decreasing rates until we start to see a substantial decrease. Here is core PCE with a year-over-year price. You can see that we are starting to come down, which is what we've been waiting for.
Yeah, it has been remarkably sticky, and you're seeing headline CPI and PCE come down more quickly than core PCE, which is definitely a little bit problematic. And we're still more than double the target. Plus, I also think, like as we've talked about before in the video, that as you get to that last, 0.5% is going to be much harder than the first 0.5%.
Oh, absolutely.
So it's going to be more and more pain to get closer to the target. However, I'm still reluctant to think that it can't be achieved with the current monetary tightness that we've already experienced. That they're not going to continue to ratchet up to a significant degree going forward.
Agreed. I'm going to show you some of these, but so why not TLT leaps? So I'm just saying here, leaps are possible. They wouldn't be bought until after the rate hike, as well as not until he hints that there could be a decrease in rates. Because the last thing you want to do is buy a 2-year option and have theta decay for 18 months before something happens. Once it starts going down, it should be fairly consistent, I would assume. It's rough for the government to keep it at this rate for a long time because they're eroding our entire economy essentially. They're so in debt. Being at this rate is not fun for them. So,
Yeah.
and then TLT is only investment. So if you think rates may chop for a year, during which time cover calls can be sold, as well as cash secured puts, I personally think the market looks toppy as hell. I don't know about you.
I don't know.
No one
Honestly,
knows.
I've thought that for the last like 6 months.
Yeah, that's true. Then someone said, why not a leveraged 3 times, which is TMF? This would be a bad call. I get it. It seems like a no-brainer trade, so why not risk more money? But the variable that we have no idea about, and that Jerome has hinted, is that he has said multiple times, we're going to be fast to get to the terminal rate. We don't know how long we're going to stay there. The last thing you want is to be in a 3x levered ETF, which decline over time due to volatility decay, and sit there for 2 years. You're fucked. This is one of those things where you can be right and you're screwed. Mm-hmm. So
yeah, there's a lot of carrying costs for them to maintain that leverage, and that would be just destroying your value throughout the entire time period. The same holds true for the leaps, whereas the leaps maybe after the pivots already started to happen, you'll be far less profitable, but at that point you're kind of more assured on the pathway we're on at that, without
less
having
risk.
to anticipate the actual pivot, which is like good luck.
Yeah, no one knows when the pivot's going to be. We don't know. And what I would recommend to people is don't read one article. Just listen to. They're wrong every time. That's one thing I learned about listening to this thing with Vinny every single 2 months when they were meeting, is that all those companies just want clicks. It's wild. Some of them would actually take out statements, but geez, it was just oh, this is the last one every time. No, it's not. He said this is not the last one. What are you talking about?
Yeah.
I've already shown this, but the theory here is you got 4 places to put your money. Okay. So you have savings or savings vehicles, money market funds, what have you. You have stocks, TLT, and real estate. My opinion, my humble, stupid man opinion, is I have money for real estate. The interest rate's so unappealing and gross. It's just so crazy. I don't want to buy it. It's too much. I personally think stocks are looking very toppy and cannot possibly continue at this rate. I could be wrong. I could definitely be wrong. And I think that with a wheel strategy of a chop zone, which once the chop zone is determined, it's a lot easier to determine where you do puts and calls. But we have to wait for that chop zone to appear. And for people who say TLT is not a stock, it does not respond like stocks do, I would agree. Look at the chart, though. It does. And I have no answer for that. But it weirdly does. It will respect resistant and stop lines. I don't know why. I don't get it. I personally think that it'll be better than the 6% a year you can get in savings.
Yeah, I mean, I guess that's true. I'm getting 4.4% in a high yield savings account right now, but that's kind of the best you see out there.
Robinhood's 4.9.
Another thing too is with the resumption and kind of student loan repayment coming here in September, you're going to see a lot more kind of capital being sponged away from the market towards student loan repayment. That's one thing that I'm actually personally going to focus on. I think my highest rate one is 7.6%. So that's a pretty solid return on my money if I just pay that thing off.
Yeah.
Which I'm excited to do.
Or move countries, change your name. Always the solid thought.
Yeah.
All right. Hopefully we got all those questions. If there's any more, just throw them in the chat and we'll answer them. All right, guys.
Get to the next one.